Hi, it's Mark Ferguson with Invest for More. I'd like to thank you for watching another real estate investing video. Before I get started, if you have not seen my blog, investformore.com, I highly suggest you check it out. A ton of great articles there. They're all free. Lots of great information. Go take a look. Information on rental properties, fix and flips, becoming a real estate agent, and a whole lot more. So today I want to talk about stock market returns versus real estate returns, specifically rental properties. I believe rental properties will blow the stock market out of the water almost every time if you buy them right. For retirement, especially rental properties are the clear winner in my mind. I'm going to go through all of that and tell you why they are such a great investment. First, let's talk about the stock market a little bit. I used to invest in the stock market. I still have some of my IRA in the stock market. I don't know why, because I really just don't like the concept of it. The whole idea of investing a certain amount every month into a stock market or mutual fund, waiting 30 or 40 years for that money to accumulate into something big enough that I might be able to retire on, and then hoping that I don't live long enough that I run out of money in my retirement, just seems crazy to me. The whole concept is a guessing game. You don't know what returns you're going to get with the stock market. You don't know how long you're going to live. You don't know if you're going to be healthy enough to work as long as you need to work. You don't know how much money you'll need in retirement either. If you have serious medical problems, you might need more money than you think you will need now, being a healthy person. If you want to retire early, it's going to be very, very difficult to use the stock market. You have to build up so much money. It has to last so long. It's crazy. Unless you live just super, super frugal, never buy anything, just bare bones minimum, don't spend any money. It's really hard to retire early with the stock market unless you just have millions and millions and millions of dollars already saved up. So why is the stock market so hard to retire on? Number one, the stock market and mutual funds have a lot of fees that most people don't know about. Tony Robbins, is a great book, Money Master the Game, talks about it. Many 401ks, many IRAs, many mutual funds are charging 1%, 2%, even more than that on people's money they invest, and people have no idea. So while the stock market may average 7% to 10%, over the history, you don't really, depends on what point in the stock market you're looking at, what the historic returns are. You're probably not getting all of that money. You're not investing all of that money because you're paying fees on it before it's being invested. The people who are investing your money, the mutual fund owners, the investment guys, the stockbrokers, they're all taking a cut of that. A lot of those guys get paid based on what fund they send you to. They try and send you to the most expensive fund that gives them the most fees, not the best fund. And trying to pick clear winners is virtually impossible. I mean, Tony Robbins does a great job of explaining the game, how it works. These companies will start 5 different mutual funds, and then maybe one out of those 5 will beat the stock market, and then they can close the other 4 and say, hey, look, we've got this awesome fund that's beating the market every year. Come invest with us. Well, if they start enough funds, obviously one of them is probably going to beat the market. They can advertise it, get people to invest in it, and oh, big surprise, it doesn't beat the market anymore because it was purely luck that it beat it in the first place. Very rare that anybody beats the stock market. Very rare people will actually see the returns or think they're going to see because of all the fees they're paying. So that's the first strike against the stock market. Number 2, when you do those retirement calculators, when you plug in how much money you're investing every year, what percent you're going to make every year, and then you come up with this figure that you have to invest for, a lot of times it's not taking into consideration inflation. I mean, 30 years, 40 years, money is not going to be worth close to what it's worth today. $2 million in 30 years, might be worth $1 million or less than it is now. So just because you have this projection of making $2 million in 30 or 40 years. That doesn't mean you're actually going to be making that in today's dollars. It's going to be a lot less than you think. It might not be enough to live on. You might have a big surprise come retirement time when you realize, oh wait, money is worth half of what it was when I planned for this, and I'm living half the lifestyle I want to live when I plan to retire. Not a good situation. So, what about rental properties? I have rental properties. I have 13, have a 14th under contract. One of my huge goals is to buy 100. And part of the reasons are I can retire so much earlier with rental properties than the stock market if I want to. Now, I probably won't ever retire. I love real estate. I love working. Very fulfilling. But if I wanted to retire, if something major happens in my life, I have the option. My 13 rental properties will make me close to $7,000 a month right now. I don't say they're making that now because one is still being repaired. I just bought it and it's not rented. But in 2014, my properties, I had 11 rental properties. They made me $6,000 basically every month with those 11 rental properties. And that comes in every month. I never have to worry about eating away from the principal balance of my investment. The stock market, you might build up to $2.5 million by the time you're 60, we'll say. Then for the next 20, 25 years, you slowly eat away at that money until it's gone. Hopefully you don't live too long. Hopefully you don't die too soon and you don't end up using it. With rental properties, as long as you own the property, it's providing cash flow. You're not eating away at the principal balance because you're not selling the property. You're not, selling off part of it. You've got that whole property is providing cash flow. That's why you can retire early with rental properties as well. That $6,000 I've got now is going to last me the rest of my life as long as I own those properties. In fact, it's not just going to last me the rest of my life. It's going to increase as I get older, as time progresses, because rental properties are an awesome hedge against inflation. And it's very simple why that works. The stock market, you're invested, you're assuming those 7 to 10% returns will keep going, but that has nothing to do with inflation. If inflation is 3%, you're not making 7 to 10% on your returns, you're making 4 to 7%. Now all of a sudden you take away 1 or 2% in fees you're paying, you're making 2 to 5% on your money every year. I mean, that's not very much. That's not going to get you very far. With rental properties, as inflation goes up, your rents are going to go up. Now, there's no guarantees with any of this, but there's a very good chance rents will go up. The value of the property will go up as well. If you leverage the property, meaning you put a loan against it, that inflation, appreciation, is going to make your returns even higher because you're not spending the entire amount of the property in cash to buy it. If you pay $100,000 for rental property and you get an 80% loan to value loan against it, you're only putting $20,000, maybe $22,000 with closing costs into that property. But if inflation is going up 3% a year and that property is following it, or even less than it, only 2%, you're still making more than that because you only have $20,000 into that house, and the property is increasing based on the house value, which is $100,000, not the $20,000 you put into it. So your money is actually increasing faster than inflation. It's the same for the rents. Your cash flow, if you have a loan against it, say your cash flow is $400 a month, and it's based off a $1,500 a month rent payment, when that rent goes up 3% because you have leverage, you're actually going to see your returns increase by more than 3% each year. It's going to just keep going up and up and up. It's just a fantastic investment. Plus, we're not even considering the fact you're paying off your mortgage. So at some point, when you pay off your loans, assuming you don't refinance them continuously, you're going to have a big jump in cash flow when that loan's paid off. Eliminate your mortgage payment, huge jump in cash flow, going to increase your returns even more. And it's just the tax advantages are fantastic with rental properties. The equity you can build up if you want to when you get to a certain age. You say, hey, I just want to sell my rental properties. You'd lose your cash flow, but you'd still have this huge chunk of cash coming in from the sale of your properties. It just is a no-brainer. What is the better investment when you're considering retiring? Either you get a big lump sum with the stock market, that you're eventually going to eat through and hope you don't run out of money, or you're going to have properties that provide steady cash flow that last as long as you own that property, month after month, year after year. You're going to get that money. That's why you can retire early with rental properties. I don't have to save up $5 million when I'm 40 to retire to maybe get, $10,000 a month off of. I can do that with a quarter of that investment or less, probably a lot less, with rental properties because of the cash flow they produce. Now, it's very important that you buy the right rental property with cash flow. Buying below market value is a huge advantage as well. Like I said, I talk a lot about this in my blog, investformore.com. You can't just go out and buy any house and assume it'll be a good rental property. You've got to make sure you buy the right property and it's going to make you money. Now, another advantage of rental properties in a down market. So, in the 2000s, obviously, we saw the housing crisis. Housing prices plunged. The stock market dropped like a rock. Some people lost 40% or more of their retirement in the stock market because prices went down so much. Now a lot of that is recovered, but still, that's a huge shock. If you've got $2 million in the bank and you're planning on retiring with that money, and all of a sudden it's worth $1 million, I think that changes your retirement plan a lot. Are you going to have the time, the patience to wait for that stock market to possibly recover? I mean, it took, 5 to 10 years for some people to get their money back up to where it was before. With real estate, yes, you would have lost equity in your house. Depending on your market, you could have lost 50% or more of the value of your house. Your house goes from $100,000 down to $50,000. That's a big hit, but it's a paper loss. If you still own that property, if it's still making money as far as the rental goes, you didn't really lose that money unless you sell the house or you lose it to foreclosure or something else happens with it. But if you bought it right with cash flow, have plenty of reserves, and can weather that storm, that property should still make you money even though the value drops so much. That's the great part about rental properties. Your stock market, you lost 40%, 50% of your investment. You now have to save 10 more years for retirement. With rental properties, you're still making money. Maybe the cash flow goes from $400 a month to $200 a month, or maybe $100 a month for a few years. Then boom, it probably will pop back up like it did. You're in the same position you were a few years later. Probably even better off because the real estate market has recovered so nicely. Huge advantage. So one final thought. I hear this all the time from stock market guys. They say, well, there's no comparison of real estate with the stock market. Stock market beats it every time, and I have proof. Look at the historic returns of the housing market versus the historic returns of the stock market, and you will see the stock market has better returns than the housing market. And they say that because half of them don't have any idea what they're talking about. They don't know themselves the error in that argument, and the others assume the people they're talking to will not examine that argument as much as they should. The simple fact is comparing apples to oranges is completely a ridiculous argument, because if you're investing in real estate, your returns are not the historic average of the housing market. The only way you could mirror the historic average of the housing market is if you bought a house for all cash, didn't use any leverage, all cash, rented that house, and broke even without making any money the entire time you owned it. So I don't know about you, but when you buy a house for cash and you rent it out, it's virtually impossible not to make some money with an all-cash purchase. Now, there might be some areas, some crazy markets where rents are really, really low and prices are high and you can't make money with a cash purchase, but 95% of the places in the United States, if you pay with cash, you're going to be making cash flow, you're going to be making money every month. And that argument that the historic housing price index is lower than the stock market returns does not consider any cash flow. It's just looking at house prices. So once you add cash flow into it, all of a sudden, oh, well, we beat the stock market. That wasn't too hard. And that's just paying cash. When you add in leverage, when you add in equity pay down, when you add in tax advantages, real estate investing blows the stock market out of the water as far as returns go as well. So the argument that the stock market makes more money than real estate is not valid because they're not comparing stock market returns to real estate investment returns. They're comparing it to real estate housing prices, which is not real estate investing. If you invest right, you will have houses appreciate, plus you will get cash flow, plus you'll have equity pay down with leverage, tax advantages. It's about 5 different things that argument doesn't consider to try and make stocks look better than they really are. Alright, that's all I've got for now. Thank you for watching. Please check out the blog, leave any comments, and subscribe. Love to have you. Thank you.